I know I have a hard time explaining this to the average person.
Yeah,
Even my best friend when we're out to dinner, I know from reading the book, Nelson Nash's book, that
yeah,
it's an amazing product. But when people hear whole life insurance, they automatically shut down, and then to be able to explain that it's a great alternative to like their 401k as an example.
yeah.
Can you just pretend I know nothing and just try to break it down for why the average person should be interested in doing this for their finances.
Yeah, definitely. So if I'm talking to someone on the street and they just just ask about, hey, what does your company do? What I'll say is
Yeah.
our company really just specializes in whole life insurance. That's the only product we sell. And why people come to us is because they're interested in a whole life insurance policy and they really just want to make sure it's set up correctly from the beginning with respect to choosing the right company, choosing the right product, and then just having us keep in touch with them forever. Every 6 months is a process. We just reach out to keep the relationship, have review meetings as often as needed. But that's what our company does in a nutshell. Whole life insurance, really with a laser focus on the cash value.
Okay.
So when I say that to someone, usually the response is, okay, like that's it. So what I'll usually do is ask a follow-up question, which is just, are you familiar with whole life insurance? Have you ever been exposed to it before? Have you ever owned it, been pitched on it? And really see what they say. And in my experience, a lot of times people have heard about whole life insurance or they've seen an illustration. And the common response or reaction I hear is, yeah, I saw it and it was absolute trash. There's no way I would put money in that. Yeah, because you can take a whole life policy. And if you're interested in the cash value, it is absolute trash. It's junk. Like I wouldn't put money in a traditional policy.
Right.
Yeah. So that's the common response. Or I'll say, yep, most people think it's junk because a lot of times it can be. However, really what we do for individuals is help them set up policies just like the ultra wealthy do, or just like corporations do, because I took everything that we do for corporations and just do that for individuals. Like that's what we do.
That's awesome.
Yeah. So I'll explain it very briefly as far as why people do it, why people put money in whole life insurance for the cash value
Hmm.
is because they view it as a safe area to put money
Okay.
that they could use like a personal line of credit. And it has a really nice tax benefit, meaning you can
Okay.
use
That's
the
good.
cash value tax free if you do it right. So
Hmm.
it's really those three core benefits: safe place to put money. I can use it like a personal line of credit instead of going to a bank or a lender or something like that. And it's got a really sweet tax advantage, especially if I'm in a higher tax bracket.
Okay, awesome. So that's a great explanation. Thank you. Can you now explain if somebody had the choice of, maxing out their 401k or
Yeah.
stopping their 401k and going with a whole life insurance policy with this max cash value with you, what would be the pros and cons on that?
Yeah, that's a good question. And typically how I like to approach it is just going over the pros and cons and really just helping educate the individual and letting them pick what they're most comfortable with. What I really make it a point not to do is to beat up a 401k or any other strategy and try and just
Sure,
convince them to put more money in life insurance.
sure.
Because, yeah, the person that's selling the 401k or any other investment or life insurance product, they're going to do the same thing. Usually they just try and attack the other and make themselves look good. And I
Yeah.
absolutely dislike that. So I'm
Yeah.
like, no, I'm not going to do it. So to hit on your point, when we're talking about a 401k and a life insurance policy, what I'll ask first is, hey, with your 401k, do you have an understanding of how it works? Or would a quick overview be helpful?
Mhm.
I'll always ask that because if they know it, yeah, when I put money away, I can write it off my income this year, deferring it. I just want to use it in retirement. If they get it, that's great. If they don't know it, then I'll give them just the highlights.
Mhm. Mhm.
For example, with your 401k, that is one of the best areas to save money and grow wealth.
Mhm.
The reason why, because any money you save is with pre-tax dollars, so you don't have to pay tax before you pay into it, which is
Mhm.
nice. As it grows tax deferred. You can choose to have it invested wherever the administrator or company that it's with allows you to invest it, whether it's in aggressive stocks or if it's in conservative accounts. You can diversify and you can be creative like that, which is nice.
Mhm.
So a lot of people like it for that reason, and it gives you a nice upfront tax break.
Mhm.
Where some people dislike it is, one, during your working years, there is rather limited access to it.
Very much limited.
Yeah, there is. So if you want to be able to use the money for real estate or business or whatever it might be, it can be challenging in that respect.
Yeah.
And then what a lot of people aren't aware of, or I'd say a trap that they fall into sometimes, is when I'm working, I typically have a lot of write-offs. My deductions are at their peak.
Yeah.
When I retire, deductions are usually limited, or they're not what they used to be. So I'm not writing off as much income. Now, if I'm going to take my income from a 401k or a qualified account, I've deferred all of that. So I'm going to pay 100% income tax on that. And if I don't have anything to offset that, I can see myself spending more or paying more in taxes.
Yeah.
Also, sometimes people feel, hey, I'll need less money in retirement. That could be true, but a lot of times what we see is people end up needing more than what they think just to cover the basic necessities, let alone what they'd like to do in retirement. And a big reason why is because inflation occurs. They might want to enjoy themselves. So if I'm forced to take more money from this qualified account that I've got to pay more tax on, that's where it can kind of hurt and say, hey, I need more here. I don't really like how this is working. Does that make sense? I'm talking a lot about this.
Yeah, no, it makes perfect sense. So now I'm just kind of like anxious to get to why the IBC policy actually is, in my opinion, I know, like you're saying, we're not bashing 401ks, but why is better in my opinion.
Yeah, definitely. So I'll go through that with the 401k first, just to make sure they've got awareness and then can decide to put as much in the 401k that they want to, as opposed to me say, hey, don't do this because it's dumb. It's like, no, I couldn't say that anyway.
But you make a really good point, because when you do take it out, like I know my dad had to write a really big check. In taxes, and then that you have way less than you expected or than you really realized. And then the stock market goes up and down constantly. So, I mean, you could, if you retire at a bad year, you could have lost years and years and years of savings. For me, that's one reason that I like your investment vehicle better.
Yeah, definitely some drawbacks there, to say the least. But people have done very well too. So we'll always weigh that. That way they don't feel like we're trying to convince them to abandon ship.
Yeah, sure.
So with the whole life insurance policy, why people will often put money there is, one, because it's a safe area to position money. I know when I put money into that product over the life of the policy, it's probably going to earn a net growth rate of between 3 to 5%, maybe a little bit higher if dividends go up and then stay up for a while, but to be conservative, say 3 to 5%. Okay. So we can consider it a fixed asset in that respect. Okay. Now you also have the tax advantage. So if I'm in a high tax bracket, say 30 or 40%, and I can earn 4% without any risk at all, and no taxes that have to be paid on that, that's going to feel more like 7 or 8% when you look at the actual numbers. Because if I earn 8%, I have to pay taxes. It's going to drag the effective return down. Yeah. So that's appealing to a lot of people. But the big thing is really being able to access the money. So if I have money in cash value that's compounding at 4%, and I can borrow against that like a personal line of credit while my money continues to stay at work for me, that's the attraction there. Okay. But I can give you a quick example of that, because sometimes people scratch their head when they first hear that. Is if I have $100,000 in cash value, say it's compounding at 4%, I borrow $50,000 against it to invest in some property or whatever I want to do. When I take that $50,000 loan against my life insurance policy, I've got $50K remaining in equity. However, I'm still earning that 4% compounding on the full $100,000.
Yeah, that's so cool to me.
Yeah, just like real. Real estate, if it continues to appreciate every single year. So a lot of times we'll explain how real estate works and then say a life insurance policy is just like that, but with some guarantees and such. And then go over, hey, how does that work? You pay interest to the insurance company on the loan piece, just like you would interest to a bank on a mortgage or a line of credit. The company collateralizes your death benefit, go through how it works so they're aware, but you just show them how to use it. And when you combine the benefits that come with it, the safety, liquidity, tax benefits, and they see they can use it for other things, real estate, maybe they're investing in their business, they've got this bucket of cash that just keeps on compounding over time, they can use for the fun stuff. That's more appealing to a lot of people that we work with, more appealing than a 401k, which is more of put money away, forget about it, and I'll have it in retirement. The whole life insurance approach is for someone that says, I don't want to forget about it. Like I want to use it for whatever I want to use it, whether it's to continue to grow my assets or if it's to buy a car, whatever I want to do and have some fun with it.
Yeah. There's no restrictions on it and no IRS rules around what you can use it for. Like you said,
Yeah.
that's awesome. The 3 to 5%, is that just a really ultra conservative number you throw out there? Or I feel like I remembered, and there's a lot of different products out there, but I feel like I remembered there being like a floor where you won't ever lose beyond a certain amount. But then there's also an upside where if this, the investment does better, you can definitely get higher than that. Is that right?
Yeah. I can give you a quick breakdown too. So if you take a company that has a total dividend rate of 6%, take Mass Mutual for 2023, their dividend rate was 6%. 6% is just a nice flat number. It's easy for people to follow. So 6% dividend. Now, I might have a product that has a guaranteed rate of 3%.
Okay.
So how it works, to your point, the floor is that guaranteed rate. Meaning if the company does not pay a dividend, I'll still get that guaranteed piece no matter what.
That's awesome.
Now you'll see the top companies, right, have always paid dividends for like over 160 years when you look at their history. So if I've got a total dividend rate of 6%, what that means is if my guarantee was 3%, they had an additional 3%, they'll call that a surplus, added to the guarantee, which gives me the dividend rate of 6%. So that's how the dividend piece works. The part that's really, really frustrating in the industry is when you hear of a 6% dividend rate, if you've got $100,000 in cash value and the company has a 6% dividend rate, like what do you normally think your money is going to grow by, or any human being?
The full 6%.
Yeah, $6,000. However, that'll never happen. Like never. The reason why is anytime you see an interest rate, whether it's a guaranteed rate, a dividend rate, any interest rate on an insurance product, the item to keep in mind is that that's always a gross rate that the company will apply to your policy after the insurance expenses and everything that comes with the life insurance policy.
Okay.
So going back to your question with a 3 to 5%, that's the true net growth rate over the life of the policy. And historically, we've seen policies do better than that. We've seen some produce in the 6% range and such. Those are policies that lived through the 80s, very, very high dividend rate periods. So naturally, I just like to set expectations conservatively, because like if I tell you it's going to do around 4% and it does 5 or 6, it's like, all right, things are great. If I say, hey, it should do 6, and I say that to try and entice you, so you say, okay, I'll do this, and it only does 4, that's where disappointment comes in.
Cool. That's where you get a bad rap as a life insurance agent.
Correct. Yeah, people post stuff. It hinders your reputation. It's like, yeah, I'd rather just shoot it conservative. And if someone doesn't do it because the growth rate isn't high enough, that's okay. Like I'll mention it has done it before, but I'm still going to say probably in this range because I feel this is more realistic.
Yeah, no, that's very upright and honest of you. So I would imagine, tell me if this is correct, in the last couple of years when interest rates were ridiculously low, I would imagine that this was probably one of the better investment vehicles for people because it actually was higher than 0%, as opposed to like a money market fund or a CD or something like that.
Yeah, 100% correct. Yeah.
Okay.
Yeah. hmm
However, the stock market, people still made money in the stock market because that has not crashed yet.
Correct. I mean, what I'll say about that is most people we work with will have money in the market. They'll have it in real estate. They'll have it in their business, and they use this as a means to complement what they're already doing.
Yeah.
Yeah,
Not
and
the
that
replacement.
yeah, that really works the best. I remember one guy years ago. This is when I was at the executive benefit planning firm. He owned a construction company, or used to own it, and he did well, right? He was worth a lot of money,
Mhm.
and he had about 7 whole life insurance policies. And what he said was, aside from the interest in the company that I've owned, I share in my business, my whole life insurance policies have been some of my best performing assets. And the reason why is because they just keep going up every single year.
Yeah.
It creates that peace of mind factor. Like, I don't have to think about it. One of the
Compounding is what
policies,
you mean, right? The
yeah,
compounding. Yeah. Okay.
yeah, I don't have to think about it at all. Stress free. He had one policy, it was about 30 years old. He paid like a $12,000 premium, and the growth was around $40,000 that year.
Mhm.
So once they get going, like anything with compound interest, it just keeps moving. But the peace of mind factor was, hey, regardless of what happens in the market, back when 2008 occurred, like, I didn't have to worry about any of this stuff, and it just kept going up. That type of mentality usually really, really likes whole life insurance.
Gotcha. Okay. Another thing that sets your, correct me if I'm wrong, but I want to say sets your company apart from other people that sell whole life insurance is the 90-10 split that you offer. I know before I found you, I had signed up for a policy, an IBC policy with another company that had a 60-40 split. And I ended up paying, it didn't perform nearly as well. And I ended up paying a lot more than I needed to. And then I went with you, and the financial picture looked much better. Can you explain to everybody what that's all about?
Yeah, definitely. So that 1090 or 9010, what that has to do with is when you pay money into a life insurance policy, a lot of times people just think, hey, it's life insurance. Whatever the premium is, it is. I pay it. I've got life insurance, and eventually cash value builds up,
Yeah.
which is a basic whole life insurance policy. What many people are not aware of is you can actually choose where your money goes in a life insurance policy.
Mm.
I can decide to pay it into the premium, which first buys me life insurance and then eventually builds cash value. Or I can pay it right into riders that show up in cash value, give me a little bit of death benefit, but I see the cash value there right away. It begins to compound. I can access it. That's how I accelerate the cash value growth, by getting more money into the cash value immediately. So the 1090, where that comes from, is insurance companies have different limits as far as whatever I'm paying in, say it's $1, what percentage of that dollar, or what's the minimum percentage of that dollar that can go toward the insurance, and then let me get everything else toward cash value.
Yeah.
That's really what we're trying to do. And that 10% minimum premium, we've seen that. I've seen a lot of the major mutual companies, your big four, have close to a 10% minimum when you design it correctly. Some allow it to be a little bit lower. Some are not that aggressive. When you start to look at other smaller carriers, some you can get it down to 5%. Some have a minimum, of 25%. So it's not a hard rule as far as 10% being the absolute minimum.
Mhm.
But a lot of times it is when you look at different carriers. So really what we're looking at is, what are the rules of the game? Meaning, what are the insurance companies' limits? How low can you go in the premium? Minimize it as much as you can. Stress test it to make sure we don't trigger a modified endowment contract, which is a taxable event. Set it up right. This way the individual has maximum cash value right out of the gates.
Mhm.
They're only committed to the 10% minimum premium. So I can commit to a small amount and add more at my discretion. That way it's very flexible. And then I see my cash value right away. So I start to enjoy the benefits. It gives you more value, and it copies like what the corporations do too. That's the name of the game.
So to give you a plug on that, I really appreciated that you offered me that. How do you say it? 90-10 split or 10-90? What's the proper way to say that?
I usually say 1090, but it doesn't matter. We know what you mean. Yeah.
Yeah. I appreciate that you offered me that because you were vested in what was best for me, my best interests, as opposed to a typical salesman that gets the bad rap. That's why other places sometimes offer a different percentage ratio, because then that means that their commission is a lot higher. But then I'm getting I don't know the right word.
More cash. Yeah.
There you go. Yeah, exactly. And so with your policy, I was able to reach my financial goals much quicker. And I guess in a way you took the hit by having a less commission, but you did the right thing for me as your client. And I think that just says a lot to how you run your business, and why I feel so comfortable to send people your way for your ethics that way. And then I had a question about the 1090. Does that mean that the death benefit, like if a person was set up that way, the death benefit's a lot lower in the beginning?
Yes. So you'll see in most cases with those minimum premium designs, we'll attach term insurance and such to it. It's mainly for the tax limit, so we don't trigger a taxable event. But in the majority of cases, your death benefit will be lower when you start the policy. However, long-term, you'll often end up with more cash value, or you always will, just because what you'll see with a life insurance policy is at age 100, usually the cash value and death benefit are equal.
Oh.
So what happens is the cash value gradually catches up as we get older and older. So what that means is the policy that has the most cash value long-term is also going to have the most death benefit long-term. And it's usually when I'm in my 80s where I'll see that minimum premium design, that 1090 split, have more cash value and death benefit compared to what a different setup would.
Oh, interesting. Okay.
Yeah.
No, that was great. Thank you for explaining. So your firm works with, do you guys do commercial accounts as well? Not just individuals?
Yeah, like work with small business owners and corporations.
Yeah. And what about banks?
Yeah, so we do have one bank that we work with that is one of our largest clients, but we are authorized in that space to write bank-owned life insurance. Yeah.
Nice. Can you explain real quick why even banks use this policy?
Yeah, so they shove a ton of cash there. Usually banks will put as much as they legally can. When I say legally, that there's regulations as far as how much cash value life insurance banks can have. There's even limits as far as how much they can put with each life insurance carrier. So they put so much there. There's a number of reasons. One is the cash value. It's considered tier 1 capital on their balance sheet. And what that means is it's viewed as something very, very safe. So it's safe money they can put there. That's a big point of attraction.
Yeah.
It grows tax deferred. Banks usually do not access the cash value. They don't really have a desire to do that, but they see that cash value grow and they don't have to pay taxes on the gains every year. Okay. So that's also attractive to them. They'll often place the policies on executives, officers, sometimes all employees. They can put it on whoever they like. And when they put the life insurance on an employee, say you and I are an employee at a bank, they say, we want to take these policies out on you. We'll have to sign paperwork to acknowledge that, yes, we know that a life insurance policy is being taken out on us. And that's it. Typically, there's no underwriting for any of the employees or nothing like that. Some banks, not all, but some will say, hey, we would like to offer a portion of the death benefit to the employee's family. If anything happens to them, it's usually like 1 or 1.5 times their salary. That's a nice benefit. Some community or family-owned banks will set it up like that. But you'll see some banks do that as far as offering a benefit to the employees' families. But really, like, the appeal there, aside from the cash value growth, is if we're employees of a bank, the bank's going to spend a lot of money on us as far as 401k matches, health insurance costs, additional benefits. Like, there's a lot of costs that come with employees that is in addition to their salary, right? A lot of times we forget about this. So a benefit to bank-owned life insurance is that death benefit is always paid income tax-free to the beneficiary. Beneficiary is the bank in this case. So how they view it, the term used is a cost recovery.
Gotcha.
It helps recover those costs. If you can account for inflation, that's great too. That can be tough sometimes depending on the environment, but that's really what they're looking at from a long-term perspective. Those large tax-free death benefits coming back to the bank. The cash value is also attractive as time passes too.
Okay, so does that same exact concept that you just laid out with the example of a bank, does that same concept apply to any business, basically?
Same concept, yes. It's a different product in itself. So banks, they've got some regulations as far as the product they can purchase. It's just a one-time lump sum purchase, whereas, and it's called bank-owned life insurance. Only banks can get it, so it is different.
Gotcha.
But it is the same concept. Like what we'll always do is take that bank-owned life insurance model and mimic it as closely as possible with individual policies, which can be owned by a business. So we do put that same concept in practice for small business owners and even corporations. The difference is you set it up where they have access to the cash value too, because with banks, they usually don't access the cash value. It's just viewed as a safe place they can plow money into.
Gotcha. Okay, so I'm curious, as an example, the company I work for, we have just part of our annual enrollment, they offer, I think, one time your base pay for, life insurance payout.
Yeah.
So that made me wonder, do you think?
Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.